Right, let's do a market check-in for you. It was a better day on the markets today. US markets are up. The JSE all-share rising by more than 3%. And we've seen for a while a lot of concerns around inflation around the world, aggressive interest rate hikes, not to mention banking sector problems. So let's find out what's causing all this optimism. We're joined by Gary Booysen, Rand Swiss Portfolio Manager. Gary, what's happening today that makes it different from many of the other days that we've seen?
Yeah, so I think, it's, I suppose, something that happens quite often in bear markets. So when you've got a market like we're facing at the moment, it's called a bear market rally, and they are normally fairly aggressive. And it's always difficult to point out the exact reason why it's rallying, because it can be as simple as something like short covering. Now, there's obviously a number of positive data points and a number of positive news items. So I think the market's certainly taking some encouragement from the reversal in the fiscal policy by the UK. The idea that the UK monetary authorities, or at least the UK Treasury, has decided to essentially reverse its aggressive tax cuts for the more wealthy citizens of the UK. That has helped to boost sentiment, but also obviously around the issues that we've seen with a bank like Credit Suisse. The idea that there could have been contagion across the European banking sector, that those fears seem to have eased today, and we're seeing that stock price up fairly aggressively as the market, I suppose, gives it the benefit of the doubt, and that's triggered a broad-based rally across particularly commodity stocks. So we've got the likes of Anglo American Platinum up over 9%, Kumba and also up well over 8%. So doing very, very well, as I suppose risk on appetite takes hold once again.
So Credit Suisse, I mean, if there's a fundamental problem, that doesn't go away in a day. And yesterday people were saying this is a Lehman moment. Their exposure is much bigger than Lehman, and all the alarmists were going crazy. Today everything's bounced back. But is there a risk there for the global banking sector? Is it something that South African banks are watching, something that could affect us down the line? How serious is that risk?
Well, I think whenever you look at a bank and you look at a Lehman-like event, it's banks are essentially to an extent black boxes, and one of the problems is the information flow between banks, and it's why people get so skittish when there seems to be smoke. They generally just assume that there's definitely fire underneath that. Now, Credit Suisse is quite a unique situation. So if you look at the credit default swaps, which are essentially it's an indication of how much it costs to insure against the default for the bank. And remember, if a bank defaults, that's pretty much its reputation gone. It's an enormous deal for a bank. It obviously affects every type of asset that the bank is holding. Now, those credit default swaps have been rising, aggressively over, let's say, the last 6 months. But we did get a spike up over the last couple of days, and that was pricing in the risk of default at Credit Suisse at around 23%. Now, this was actually triggered by rumors over the weekend on social media that the bank, and there were two issues really. So the one issue was that the bank wasn't well capitalized, and if you look at their essentially what we consider tier 1 capital ratios, which is their CET1 capital ratios in the EU, they are very well capitalized, but there's always this fear that potentially they're not, or potentially that the assets that they're using are not secure, or there could be something funny underneath it. Now, what's happened is, based on the social media rumors, one, that they felt that the bank maybe didn't have the liquidity that it was reporting, which is of course an enormous deal. Like that is incredibly dangerous, and that was one of the reasons that the CDS started to spike. The other element was that Credit Suisse is currently going through a restructuring as well. Now, as part of the restructuring, the rumors surfaced that they potentially would tap the market, via a rights issue. Now, with their share price having collapsed, and their share price is down around 75% over the last 5 years, it was seen that this rights issue was going to be very, very dilutory. So, essentially, equity holders were going to take a big knock if they did need to raise capital from their investors. Now, that was the second rumor. Now, what Credit Suisse has been doing, it's been going around to all its clients and phoning all of its major shareholders and trying to reassure them that this isn't the case. Now, unfortunately, the market also read that as they are phoning them to just try and see if they would be prepared to essentially if they were to raise capital, would they be prepare to follow their rights. So that kind of almost added fuel to the fire, which made everyone even more nervous. Now, what we have today is just a settling of those nerves. And if you look at it, it was a lot of prominent voices saying that this could be a contagion. This could spark a European banking crisis, absolutely. But if you go and read the analysts that cover the bank and read their reports, they were quite adamant that this is a well-capitalized bank and this is absolutely not a Lehman Brothers. It's not a Deutsche Bank moment either, and this doesn't have this probably won't result in a contagion spreading across the Eurozone and all the way down to South Africa as well. So markets definitely a lot more optimistic today. Obviously the stock price of Credit Suisse has rallied almost 9%. It's up 8.86% at the moment. So, very, very strong rally in the equity price. But we're also seeing that the CDS starting to fall, which is obviously reducing the probability that the bank will default on its debt in future.
All right, so we can all just calm down for now. Thank you for counteracting the possible misinformation, a lot of it coming from Twitter and the like. Credit Suisse trending yesterday. But a lot of this is about expectations. And if you look at the bigger picture, Gary, it's about expectations of interest rates. And even that, yesterday, it seemed like everybody still expected aggressive rate hikes. Today, they expect some tempering of the rate hikes. So it's really about who's doing the guessing.
I suppose it is about who's doing the guessing, but the people that do the guessing are generally the people with the money, and it's that's essentially what a financial market is. It's everyone putting their money where their mouth is, and that's where that's how the pricing is formed. So today, fortunately, everyone they're putting their money where their mouth is and saying that things will be better in the future, and that's why we're seeing this huge rally up in markets, which is very, very encouraging. But as you said, it is all based around those expectations around certainly interest rates, inflation. What the growth prospects are, what is OPEC going to do tomorrow? Are we going to see cutting production, which is going to force up oil prices, which is obviously going to fuel certainly the headline inflation figures as if oil price starts to spike. We've already seen the Brent crude contracts trading at around $92 a barrel today, so a long way up from where they were a couple of days ago. So even though we had a very positive day on markets, as I said at the opening of the show, this is something that is very common in bear markets, where you get these very aggressive rallies, but they often do peter out. I think it's also important for viewers just to remember that it is China Golden Week as well. So we also have a lot of players out of the market for public holidays this week, which is reducing volumes to an extent. So let's hope it continues, but I don't know if we're quite out of the woods just yet.
All right, so hopefully the downward, will you expect the downward trend or the volatility to return? Finally, Gary, just very quickly, we've heard from a lot of investment houses the trend is South Africans looking at offshore investments. Is that still there, and is the advice still the same? No matter where you are invested, just hold tight and don't panic.
So I think it's important to, every financial advisor will tell you it's time in the market, not trying to time the market. But I think viewers should also just be cognizant that the rand dollar has weakened, very, very aggressively over the last couple of months. We were well above 18 rand to the dollar as that dollar strength, that safe haven trade just played out. So if you're now looking at potentially trying to deploy money, above 18 rand to the dollar and taking your rands and exchanging for dollars, you might be shutting the door after the horse, shutting the stable door after the horse has bolted. So, investors that went out, in the low 14s and are now sitting on a big almost currency payout, even though markets are falling. A lot of investors that have moved offshore are very, very well insulated, even though the underlying dollar equity markets are down because they've had that kind of almost that currency playing in their favor as well. So I think offshore markets, it really depends on the client. It is a nice way to diversify a portfolio. There's no question about that. But it's not everything. I think there are still plenty of opportunities in South Africa as well. But it comes down to everyone's individual situation. If you already own a house,
Gary, we have to stop you.
Here,
let's leave it on individual situation, because you're so right, and it depends what you've done in the past. And thank you for giving us that great wrap. We're out of time. Gary Booysen, Rand Swiss Portfolio Manager.